This is a demonstration of problem M539A, analyzing cost, volume, profit relationships. Crandall Company sells flags with team logos. Crandall has fixed cost of $583,200 per year plus variable cost of $4.80 per flag. Each flag sells for $12. In the first requirement, it asks us to use the equation approach to compute the number of flags Crandall must sell each year to break even. So we know the equation to determine target profit is net sales revenue minus variable cost minus fixed cost equals target profit. We are going to be computing the break-even point, so that our target profit will be 0. Next, we're going to determine what our net sales revenue would be, which is $12 times the number of flags. Our variable cost would be $4.80 times the number of flags, and our fixed cost would be $583,200. So what we are trying to determine is the number of flags that Crandall would have to produce or sell each year in order to be able to break even. So to simplify our equation, we're going to move our fixed cost of $583,200 to the right side of our equation and 0 to the left side. We've also simplified the contribution margin by taking our sales price minus our variable cost, and that gave us contribution margin times the number of flags. So to solve for the number of flags, we take our fixed cost and divide by our contribution margin. So Crandall would need to sell 81,000 flags in order to be able to break even. The second part of the problem asks us to use the contribution margin ratio approach to compute the dollar sales that Crandall needs to earn $33,000 in operating income for the year. So first we need to compute the contribution margin ratio per unit. So we know that each of our units sells for $12, and we know that our variable cost is $4.80 per flag, and we would divide that by the $12 per flag. So $7.20, which is our contribution margin, divided by $12, our sales price, gives us a contribution margin ratio of 60%. Then to determine our sales in dollars to have a target profit of $33,000, we take our fixed cost of $583,200 and we add to that our target profit of $33,000 and divide it by our contribution margin ratio that we computed of 60%, and that gives us required sales in dollars of $1,027,000 for Crandall to sell in order to have a target profit of $33,000. The third part of the problem asks us to prepare Crandall's contribution margin income statement for the year ended December 31st for sales of 70,000 flags and to round any final answers up to the next whole number. So to determine the sales revenue for a contribution margin income statement, we would take $12 and we would multiply that by the number of flags we sold, which was 70,000, and that gives us sales revenue of $840,000. The contribution margin income statement then subtracts the variable cost, which would be $4.80 per flag for 70,000 flags, or $336,000 in variable costs to give us a contribution margin for 70,000 flags of $504,000. And then we would subtract the fixed cost of $583,200 that was given in the problem. And we see that at 70,000 flags, Crandall would have an operating loss of $79,200, and that makes sense because we had calculated that they have to sell at least 81,000 flags in order to be able to break even. The company, in Part 4, it states that the company is considering an expansion that will increase fixed costs by 21% and variable cost by 60 cents per flag. And the problem asks us to compute the new break-even point in units and in dollars, and also should Crandall undertake the expansion, and give your reasoning. So our variable costs were $4.80. So if we increase those by 60 cents, the new variable cost would be $5.40. Our original fixed costs were $583,200, and if we're going to increase those by 21%, we would multiply that by 121% to get the revised fixed cost of $705,672. So now we are going to compute the number of flags that Crandall would have to sell in order to be able to break even, given the new information that we have in the problem. So the price for each flag has stayed the same at $12, but our variable costs are now $5.40, and our fixed costs are $705,672. So again, we're going to solve for the number of flags that Crandall would have to produce in order to break even. So we'll move our fixed costs to the right side of our equation. We have our new contribution margin of $6.60. So to determine the number of flags to break even, we take our fixed cost of $705,672 and divide it by the contribution margin of $6.60. So Crandall now would have to sell 106,920 flags in order to break even, and the sales dollars, multiplying each of those by $12, would be $1,283,040. And then, should Crandall undertake the expansion? Well, Crandall really should only undertake the expansion if the expected profits from the expansion are greater than the expected cost. So this expansion increased both variable and fixed costs, which reduced the contribution margin and increased the sales in units required to break even by 32%. So originally they only had to sell 81,000 flags to break even, but now they will have to sell 106,920 flags. So it will just depend on whether the expansion will generate enough sales volume to be able to offset the increased cost. And that is the conclusion of the demonstration for problem M539A.